Single defining rule. It doesn't care who you are. You earn it, and passing it to the next person requires zero permission from the system itself. We operate on what is essentially a dumb network. When you hand over a $20 bill to pay for your rent, or buy groceries, or cover a debt, the network asks zero questions. It is a completely blind exchange between two people. We are so deeply accustomed to this financial freedom that we rarely register it consciously. It operates silently in the background of almost every choice we make. We often mistake this systemic neutrality for a law of physics. In reality, it is just how the legacy version of money was built. Right now, the architects of the global economy are writing the code to replace that passive system. World governments are actively designing an entirely new financial infrastructure. They are called Central Bank Digital Currencies, or CBDCs. To understand this, look past the user interface of your banking app. A CBDC is a complete rewrite of the core logic of money itself, which leads to a crucial question. What happens to a society when the base layer of its economy stops being neutral and starts executing programmed rules? This chart shows the three available architectures of money. Physical cash sits in the first column. Cash has no central tracking, and it is instantly forgetting its own history. A physical dollar has no memory of the wallet it was in yesterday. In the middle, we have cryptocurrency. By design, the blockchain introduces perfect systemic memory, a permanent public ledger, but it deliberately removes any central administrator. Nobody sits at the top to dictate who can use the network. CBDCs create a totally new asset class on the right. This architecture fuses perfect memory with centralized control. A central bank can see every wallet and every transaction in real time. This structural combination enables a property that physical money lacks by design: programmability. Instead of handing out a static coin, the central bank is deploying a smart contract. The money itself can autonomously enforce the issuer's rules directly on the person holding it. Let's look at how this works in practice. If a government distributes welfare or housing subsidies as a programmable CBDC, they can geographically fence the funds. The code might only clear the transaction if the money is spent inside a local grocery store, blocking any attempt to buy electronics or travel. Consider economic stimulus. During a recession, the Treasury could issue digital relief funds hard-coded with a strict expiration date. If you try saving it, it auto-deletes on day 31, forcing you to inject that capital immediately. If you are a consumer, these limits sound highly restrictive. But if you are a central banker, this is a way to bridge the gap between policy design and individual behavior. Adjusting the economy right now requires blunt instruments, like tweaking interest rates and waiting months for the effects to trickle down. Programmability offers instantaneous data and the ability to intervene at the level of specific sectors or regions. From an engineering standpoint, this eliminates the lag between policy and compliance. The rules of the economy are no longer just suggested, they are hard-coded into the currency. When people hear about CBDCs, the first reaction is usually a shrug. Most of our money is already digital. We tap credit cards for coffee and transfer funds from our phones instantly. Those existing systems simply move passive money faster. CBDCs replace that neutrality with structured money. This chart shows the shift in logic. In Tree A, the citizen allocates capital and the money obeys. In Tree D, the money dictates available pathways based on preset conditions. The system guides the choice before the transaction even happens. This creates what is known as directional money. The exact same dollar behaves differently, based on whose wallet it's in, where they are standing, and when they spend it. This influence doesn't require aggressive force. It acts as a subtle, invisible architecture, gently limiting certain actions while incentivizing others. When the base layer of the economy is programmed to favor specific outcomes, the businesses and services built on that infrastructure must function within those preset boundaries. By changing how money behaves, we change the incentives of every person who needs it to survive.